Welcome back. You're still watching Smart Money on CNBC-TV18. We have with us Gautam Duggad, Head of Research Institutional Equities at Motilal Oswal Financial Services. And we are here to talk about India continuing to be one of the best stories amongst the global peers and what are the sectors that you should be buying. Gautam, before I ask you about banks where there is pressure, it's interesting to see that this global market rally has been far more pronounced than India this year, right? I mean, this year the Nifty is up 8%, but the S&P 500 is up 16%. So in that context, is there a catch-up that India has to do compared to its global peers?
No, honestly, Sonia, when you look at 8-9 months of a return, you are not looking at what happened in CY22.
Yeah.
CY22 Indian markets were flat, whereas rest of the global markets corrected. That's why I said if you look at 2-year CAGR, India is the best performing market globally. 3 years, we are the best performing markets globally again. 5 years, second best, and 10 years, second best. So I wouldn't read too much into 7-8 months of a performance or underperformance. It's sure fact that rest of the markets are coming back from their lows, while we have basically consolidated and grown 8-10%. Our mid-cap and small-cap indices have grown 20-25%, which will come back into reckoning after almost 4-5 years. So I won't read much into the underperformance of 8 months because it is coming on the back of a very strong performance over the previous 2-3 years.
Absolutely. Okay. Let's talk about some sectors then and stocks as well. Before the break, I was asking you how banks have underperformed, right? What do you think the key reason for that is? Is it only margin moderation and earnings coming off? Or is there, a story that the market is pricing in future?
I think there are two reasons. One is the profit moderation, which is largely a function of what is happening to the margins. So margins picked off in 4Q FY23 for banks. 1Q FY24, we've already seen 15-20 basis point of a shrinkage. And most of the managements have guided for another 10-50 basis point of NIM compression. So when we look at the next 3 quarters of earnings for our coverage companies, because we have a visibility of next 3 quarters, which we break the full year into 4 quarters right at the beginning of the year. So first quarter, we looked at private banks. We were expecting a 31% growth, whereas they've delivered 36. But this 31% growth, which we were expecting in first quarter, goes down to 12% for fourth quarter. So there is a moderation in every subsequent quarter, which is a reflection of NIM compression, plus the best of the asset quality for private banks now being in the base. Similarly, for PSU banks, first quarter, we were expecting about 96% growth. They've done about 130%. But the fourth quarter, our expectation is just about 10%. Right? So the growth is moderating. Second problem is of ownership, right? So banks are there in everyone's portfolio. Unless there is a significant positive catalyst which is not well known, I don't think a significant rally coming up in banks, because this is not a small sector which is underowned. This is a biggest sector actually in the index, which is well owned. So in financials, what we are looking at is, since April, when the RBI first put a pause on its monetary policy tightening, the trade shifted in favor of NBFCs, because they had underperformed earlier. Now you look at the last 3-4 months of performance, NBFCs have done really well. And their valuations were also quite attractive. On top of that, their asset quality, AUM, disbursement growth, and their guidance for the next 2 years on asset quality and growth is pretty strong. So that is where we increased our weight in model portfolio, away from banks towards NBFCs.
Okay.
And that is what the trade, I think, will be for the rest of the year, in my view, for banks.
Okay, so that's on banks. A couple of other key sectors that moved, right, in the past week, in the past month. One of them is these platform companies. So we noticed in this quarter's earnings, Zomato, Paytm, PB Fintech, Delivery, all did pretty well operationally. And Zomato's one call that you had taken, I think, at 50 rupees. Now it's almost doubled since then. Is it too late to jump onto this one, or do you think there's more to go?
So I would say that in this kind of companies, it's always very difficult to predict what can happen, because the listing history is very limited. Plus, their profitability history is still not established. So they're going to be very volatile. At 160 for Zomato, a year and a half back, everything looked perfect. It came down to what, 50, 45? We initiated just 3 months back at a price of about 54. And we recently introduced it in model portfolio, but I think 70, 75 rupees. Our expectation was that for the next couple of quarters, the operating profit or operating loss that they've been reporting will shrink. We also didn't expect that they will report a PAT level profit in this quarter. So there is a surprise every quarter, sometimes on the downside, sometimes on the upside. So you have to maneuver that portfolio very differently compared to other sectors where you have a lot of cyclical history, how management behaved in the earlier cycle. In this particular case, you don't have any history of how the managements and companies behaved in earlier cycles. So you have to take it every quarter and reevaluate the thesis on numbers as
like
to how
a little bit of trial and error.
Absolutely,
yeah.
absolutely.
Okay. Another space which has done phenomenally well and a lot of retail investors have missed out is defense, right? Today we were speaking with Baba Kalyani and he said that the defense vertical will contribute 10% of their overall business by the end of FY24 itself, and he's looking to double their revenues by FY25. And these are stocks which are already at lifetime highs. But do you see this as a structural upcycle?
Yeah, Sonia, but what has happened is the appreciation in the market cap in defense segment, not just Bharat Forge, I'm talking about in general PSUs, because that is where the maximum money has been made in the last 2-3 years. Markets cap have gone up by 5, 6, 7 times. Order books have grown, profits have grown, valuation re-rating has happened. So if somebody is a fresh entrant in this space at this price, at this valuation and market cap, he or she has to be very cautious because you're not entering an unexplored sector now. This is the talk of the town, which has already done very well. So your expectations have to be very moderate. Incidentally, Bharat Forge is a part of our model portfolio, which reported very strong set of numbers, and we have seen a marginal 3-4% earnings upgrade in our estimates for FY25. But for the space as a whole, I think a lot of money has already been met. From here, any stock that you want to enter, you have to be doubly sure on what you're projecting for numbers and how you expect valuations to look like in the next couple of years. Because do remember, this is also a function of the policy from the government side. And that always induces its own volatility.
Okay. Just 2 quick questions before we end the show. One is, what are the big risks in the market now? Because, you know, there are some risks on the horizon, whether it's crude, which is at a 9-month high, there's a general election coming up. In your mind, what are the risks?
So, Sonia, risk is always more from things which you are not able to predict right now. If anything you are able to predict as a risk, it means the market is well aware of that. So, crude has always been a risk for India, whether at 100 or 50 or 60, because when it is at 50, 60, you always expect it might go up. If it is at 100, you expect it might go 120. So, crude is a very generic risk for India and it's a very relevant risk. But aside of that, I think as we move closer to the election cycle, because now the general elections are hardly 8-9 months away. Yeah. So that will have a very important implications for the market, because if the results are not to the market's liking, possibly there will be a lot of volatility. If it is to market's liking, then you will see the momentum continue. So that is one important risk I would think, apart from the usual global risk on rates, inflation, commodity. Those are pretty well known, and I don't think market will sort of react very strongly to those kind of risks, because there's a lot of money lying on the sidelines which is waiting to enter India. Okay. A lot of new avenues of money from different markets of the world which is entering India. You've seen money coming in through markets like Japan, Korea, Asia Pac. We've seen that reflected in the FII flows already. You know, I think December 21 to February 23, you had seen about $16-17 billion of outflows. That has been recouped in the last 5 months. Okay. So, to put it other way, since December 21 to now August 23, the FII flows have been zero. Whereas the domestic flows have been somewhere about $54-55 billion. Oh,
wow.
So okay, there is a lot of capital waiting to enter.
There is a lot of capital. Okay, got that. Gautam, before we let you go, one final question, because, you know, there are a lot of young investors that are coming into the markets now. And with your, I think, over 2 decades of experience, what is the one piece of advice you'd like to give an investor who's just starting his investment journey?
I think it's a very standard advice, Sonia. I mean, what has worked in the market is patience, discipline, and time in the market, which is what all the investing greats have been writing about since many decades. Second, the biggest risk in the market that you asked is not being in the market, right? Last 10 years, your profits have compounded 13-14%. Markets have also compounded 14-15%. And that's how the journey of market has been. If you're able to enter at the lows of the market, whenever there is a crisis, your compounding goes up by 3-4 percentage points. If you enter right at the peak or at the euphoria when everyone is talking about it, maybe your compounding is 10-12%. But the biggest risk, I think, for any youngster is not investing in the market. Because the earlier you invest, the larger the time frame for your capital to compound. And that's a very, very important thing, because compounding is what has created the biggest wealth in India.
Okay, that's some really sane advice, Gautam. As always, thank you so much for joining us. It was the most informative half an hour that we could pack in for our viewers. With that, it's a wrap on this edition of Smart Money. Thanks a lot for watching. Keep writing to us. We love receiving feedback from you. Have a great weekend.